Welcome back to a new video from Trading. In this video, I explain you a very unique Heiking Ashi candlestick trading strategy. This strategy is based on one of the most unique candlestick patterns in TradingView. Besides the candlestick, we use two other indicators and we trade on the 1 hour time frame. Stay with me till the very end because this strategy will make you a lot of money. First I fully explain the strategy to you, after which I will backtest it live so that you can see that this strategy actually works. Before we start we add two indicators to the chart. This is the moving average exponential and the volume indicator. We first have to adjust these two indicators. First double-click on the moving average and change the length to 100. This turns the line into a larger average. Then double-click on the volume indicator and turn on the volume MA. You can make this color white to distinguish it from the other moving average. First it is important to know what all the indicators mean exactly and what the Heiking Ashi candles stand for. Let's start with the Heiking Ashi candles and explain why they are so popular. These candles use an open and close data of the chosen period and filter in this way a lot of mess from the chart. Since we trade on the 1 hour time frame, the indicator filters out the mess on the 1 hour open and close data. In this way the trend becomes much clearer and you can hold positions longer and decide easy in which direction the market is moving. Now that the Heiking Ashi candles combine an average trend with a candlestick, we can clearly see in which direction the price is moving. But just to be sure, we've also added the moving average exponential indicator. This is the blue line we can see here on the chart. This line uses the same data, as it were, but over a longer period. We just placed the indicator at a length of 100, which means that this indicator measures an average price movement over the past 100 candles. And lastly, we added the volume indicator. This indicator shows the volume per candle. We see another moving average over these candles. This line maps the average volume. So we now have three different sources of information, all three of which map an average price movement. And we are going to respond to this in a smart way with the Heiking Ashi candle. Now that you know what all the indicators mean, we can start with the strategy. You can always execute the strategy, it does not matter whether the price moves in a downtrend or uptrend. First, let's look at the moving average exponential indicator. We want to know what the price does over a longer period of time. Is the price moving above the indicator? Then the price moves in an uptrend. Is the price moving below the indicator? Then the price moves in a downtrend. Here, for example, we clearly see that the price is moving in an uptrend. As soon as we know whether the price moves below or above the moving average, we will wait for a return to the moving average line. We want the price to touch the moving average line. This happens here and here. As soon as the price falls back towards the moving average line, it means that the price is on average cheap as it generally moves above the line. As soon as the price falls again towards the line, buyers can enter, which means that the price can go up again. We don't just jump in when the price drops towards this line. Before I tell you when you can enter, I would like to ask you if you have already taken a look at the exchange Bybit. On Bybit you can easily analyze this strategy and execute it immediately. In addition, the exchange is giving away a beginner bonus up to $3,000. You can claim this bonus by creating an account via the link below this video. With this bonus you can open free positions and, for example, test this strategy. You cannot pay out the bonus itself, but the profits you make with this bonus can. I also trade on Bybit and I am very satisfied with this exchange. You can trade with leverage and use a 4-chart layout. So it is definitely worth taking a look at it. Let's go back to the video quickly. So as soon as we see a pullback towards the moving average line, we can start looking at possible entry points. But before we actually get in, we are still waiting for two other confirmations. We are waiting for a green Heiking Ashi candle and a rising volume over the average volume line. This shows that other buyers are stepping in as the volume moves up and the Heiking Ashi candle turns green again. We are now seeing in three different areas that the price could potentially move up again while the price is already moving in an uptrend. This allows us to make profitable positions because you see that the price rises sharply afterwards all the confirmations. I'll show you another example. Here on the chart you can see that the price moves above the moving average indicator. This means that the price is moving in an uptrend and we can wait for a pullback towards the moving average line to potentially buy a position. Here the price drops towards the moving average line. At that moment we are waiting for a green Heiking Ashi candle. This one takes place here. Finally, we want to see an increasing volume over the average line. And that takes place here. So we can open a position. Before opening a position, it is always important to determine where you will sell the position again for a profit or loss. With this strategy, we always place the stop loss below the last low. So suppose you open a position here, then you put the stop loss below this low. We always place our target twice the size of the stop loss. This means that we are going for a risk-reward ratio of 2. So again, if we open a position here and place our stop loss below the last low, we pay out the position with a profit at 2 times as high. You can see that this one was closed with a nice profit. As I said, this strategy is also possible in a downtrend. I will show you an example of this. In fact, everything works the same, only we turn it around. As you can see here, the price is clearly moving in a downtrend. In this case, we want to see an increase towards the 100 moving average line. At that point we are waiting for a red Heiking Ashi candle instead of a green one. And after that we want to see a red volume bar above average. In this case the rising volume is not in the same place as the first red Heiking Ashi candle, but that is not a problem. You just get in when the first red volume bar is higher than normal. So in this example we open a short position here and now place our stop loss above the last high. Then we go for a 2 risk-reward ratio again. Some of you will wonder how exactly you can make profit when the market is falling. But that is not so difficult. The same as if you make profit when the market rises, you make money with a short order when the market falls. You can open such an order on the exchange Bybit. In this way of trading there are almost everyday possibilities. You can visit Bybit via the link in the description. I'll show you another example a little further down the chart. We see that we are still moving in a downtrend and therefore waiting for a rise towards the moving average. Here we see a red Heiking Ashi candle, but the volume is not breaking out over the average yet. So we still have to wait to open a short order. A little further on we do see a breakout in volume. This gives us enough confirmation to open the position after all. As you can see, the price has already risen over the moving average, but in general we are still in a downtrend. You can see this because the price moves most of the time below the moving average. So we can still open a short position here. I place the stop loss above the last high and take the profit at 2 times the stop loss. Again a nice risk-reward ratio of 2. I think the concept is clear. I will now backtest the strategy and then discuss the results. In an 11-month period I opened 63 positions, of which 26 closed at a loss and 37 closed at a profit. On each profitable position, I earned back 2 times my investment, resulting in a total profit of 48 times my invest. As you can see, this is a somewhat longer time frame strategy. Excellent to perform besides your full-time job or study, since you don't have to sit in front of your computer all day long. Let's see what you could have earned with the following investments. Suppose you only have a small account size and only want to lose $50 on a position, you would have made an additional $2,400 in 11 months. If you can risk a little more, like $250 per position, you would have earned $12,000 after 11 months. Suppose you have no study or full-time job at all and are already a more experienced trader and already have a good amount of capital at your trading account, you could have made $72,000 if you risked $1,500 per trade. If you don't want to analyze the chart yourself, I can advise you to take a look at our website. With our premium package, we analyze the chart for you and you only have to fill in the stop-loss price and take profit price on Bybit. We have a no-profit money-back guarantee. Thank you for watching, and I'll see you next time.